Hey entrepreneurs, if you're trying to buy a business, open a second location, or finally own that building your company's been renting for years, you might have heard of the SBA 7A loan. But there's one term that throws people off, and even some banks get it wrong. It's called equity injection. And if you're not clear on this part, your deal could fall apart. But don't worry, in this video I'm going to break it down for you. We'll cover when the SBA requires equity, how much you need, what counts as equity, and how to fund and document it step by step. Let's get into it. Let's start with the basics. Equity injection is your skin in the game. It's your cash, or something like it, that you bring to the deal. It shows you're serious. It also makes the project less risky for the bank and the SBA. There are three main times the SBA requires equity injection. A brand new business called a startup, buying an existing business, or buying out a business partner. Let's take them one at a time. If you're buying a business, SBA usually requires a 10% equity injection. But, and this is important, it's not 10% of the purchase price, it's 10% of the total project cost. That includes the business purchase price, working capital, and any closing costs. So if your total project is $1 million, that means your equity injection is $100,000. Now here's where it gets interesting. If you're buying a business, the seller can actually help you with the equity injection. Yup, the SBA allows the seller to cover up to 50% of your required equity injection with something called a seller note, as long as it's on full standby for the life of the loan. So let's say if you need $100,000, the seller can bring $50,000 and you just need to bring the other $50,000. For partner buyouts, SBA looks at your company's debt-to-equity ratio. If your ratio is over 9-to-1, they'll require you to put in 10% equity. But if your business is well capitalized, no equity injection needed. Now here's where many banks get it wrong. If you're using SBA funds for real estate, construction, or expansion, the SBA doesn't automatically require a 10% equity injection. Instead, the bank decides based on your financials. So if a lender says you must have 10%, it's an SBA rule. They might be wrong. Don't walk away from a deal because someone misread the guidelines. So where does this equity injection money come from? Option 1 is your own savings, ideally in your bank account for at least 60 days. Option 2 is a gift from a family member with a gift letter and a proof of where the money came from. Or option 3, a HELOC or a home equity line of credit, but you'll need to show repayment ability from outside the business. Now this is super important. You'll need to prove that your equity injection is real. That means showing 2 months of bank statements and being ready to explain any large deposits. Here's a real example. 2 partners each contribute $50,000 into a new business account. That's $100,000 in total. But the SBA will want to see where each partner got the money from, so they'll need statements from their personal accounts too. Remember, the better your documentation, the smoother your closing. If the SBA can see a clear trail of funds, you're good. But if anything looks like a loan from someone else, it could delay your loan, or worse, kill the deal. So now you know exactly what equity injection is, and when it's required for your SBA loan. Just remember, it's not always needed, and it's not always 10%. You might have more options than you think. If you got value from this video, give it a thumbs up and hit that subscribe button. Every week I break down SBA loans in plain English, so you can grow your business the smart way. Thanks for watching, and I'll see you in the next episode of Loan to Launch.